Well, hi everyone. My name is Jonathan Brummer, and welcome to this episode of 5 Before, 5 After. This is a channel dedicated to taking a research-based approach to helping you manage your retirement income. Today, I'm going to be talking about probably the most fundamental concept that you need to understand when you are withdrawing income from a pool of capital, and that's called the sequence of returns risk. Probably, hopefully heard about this if you've done any research yourself, if you're in this phase where you now basically have saved up some capital, you're not going to be earning a salary anymore, and you now need to pay yourself a salary by withdrawing some money from this capital that you've saved up. This could be money inside a retirement annuity, in a retirement fund, or also just discretionary money in something like a unit trust or a share portfolio. So what is this sequence of returns risk? The bottom line is that investment markets go up and down. So when you're investing, you're going to experience this. And we don't know the order that it's going to happen in. And the fact that, it goes up, some going to go up and going to go down, and you might hit a sequence where it goes down first and then up, and someone else has it the other way around, is going to um, affect the outcome that you're going to get. So let me give you a concrete example. What you have on the screen is an article that I wrote about this, which I will include a link to in the description for this video. But let's look at this example that I showed. So here we have two individuals. They are the same age. They're retiring at the same age at 65, let's say. They both have identical portfolios. They've saved up 5 million Rand. And they also need the same amount from that pool. So they're both going to take an initial 5% out of that, so 250,000 Rand a year, and they will increase this by 5% every year. Okay, that's going to be their inflationary increase. So at this point, they're both exactly the same. What's different is that the sequence of returns that they earn is going to be different. So over a 10-year period, both will earn the same average return. Both will earn an average return of 5%. But the order that they get them in is going to be different. So first, John, I've called John the lucky guy here. He starts and he earns positive returns. As you can see in this example, the first year is a great year, 15%. Then he earns 12%, and then he earns 11%. Then after that, something happens in the markets and he earns negative returns for a few years. And over the course of 10 years, when we average this all out, he's earned an average of 5% every year. Okay, so that's John. He's lucky because he started with positive markets when he was withdrawing income. Now let's look at Jane. So the same thing, same amount of money, same drawdown, but unfortunately when she retired, in the first few years, she experienced negative market returns. So she experienced minus 8%, then minus 5%, and minus 4%. And then in the years after that, actually, things recovered and she earned the same positive returns that John had earned. But the difference is that she earned it later into her retirement. Over the course of this 10 years that we're looking at, they both earned an average of 5%. So what is the difference in the outcome for these two? If we look at this chart, it's going to help us clarify what happened here. So in the blue line, this is the value of John. Remember, John was the lucky guy here. The value of his capital. It started out at 5 million. He was withdrawing 250,000 from it every year. And he was also increasing that by inflation. And you can see because his investment returns were so strong in those first 2 years, the value increased and increased and increased. And then around year 7, he started seeing some negative market returns and his value started decreasing again. So that's John's outcome. And by the end of this 10-year period, he's roughly got about 5 million left still in his portfolio. Jane, on the other hand, again started with 5 million, but she, remember, experienced those negative returns at the start. And just look at the impact. Remember, she's experiencing minus 14%? Minus 8% from her investment, and she's also withdrawing another 5%. So she's basically minus 13% in that first year of retirement. And then she keeps going on withdrawing for the next few years. Later on, markets do stabilize, and she's getting very positive returns later. But she's actually withdrawn so much from her portfolio that the value that's left is so small, so the high returns that she's getting isn't having as much of an impact. And at the end of this 10-year period, you can see that her value is now down to just over 3 million. So a very big difference in outcome between these two individuals. Just to give you a sense of the returns we've used here, you can see they're actually exactly the same between John and Jane. They just happen to be earned in the opposite order. So John got his returns, the high returns first and the low returns later. And Jane got the low returns first and the high returns later. It's an extreme example just to show the impact that the difference that the sequence of returns will make. But this is a crucial risk that we have to deal with from a retirement income planning perspective. The unfortunate thing is that we don't know if you're going to get positive or negative returns first. So we can't bargain on that. We have to use some strategies to deal with that uncertainty, which is what I will cover in future episodes. But I think that for now, there are 3 things that you should think about that will help you manage this. The first is that the total amount, the withdrawal that you take, should be reasonable. The higher the withdrawal that you take, the worse you make this problem. So someone taking 7% as an example will be in a much worse situation when they experience negative returns than someone taking only 4% as an example. So that's your first strategy, is try to keep those withdrawals manageable. The second strategy is to be flexible. Nobody says that you have to take the same amount every year and you have to increase it by inflation every year. In fact, you get a big benefit in terms of your overall outcome if when markets are down, you can actually reduce your income a little bit. So that's your second strategy. Again, I wrote an article about that, which I will link to in the description, about being flexible. And then the third strategy is having what I call buffer assets. So the key here is that if you have a pool of assets, which you can withdraw from, that don't go down when the rest of the market is down, then that's going to help you to leave the assets that are going down now because market returns are negative. Just leave them and wait for them to recover before you withdraw from that again. And the way we do this is by building a bond ladder. And again, a bond ladder I'll cover in a future video, but I'll link to an article on the topic for you in the description. So I hope that's useful. Remember, sequence of returns risk, very, very important. It means that it's not just the average return that you earn, but the sequence in which you get them. You want to try and avoid negative returns at the start. Unfortunately, there's no way for us to know that. So your 3 main strategies are: choose a reasonable withdrawal rate, be flexible with that withdrawal rate, and build in a buffer asset, something you can withdraw from when markets are down. If you'd like help with your own retirement income plan, my contact details are in the description. See you next time.